freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here today, as always, with the one and the only Adam Penn. Adam?
We've talked about this before. It's not the one and the only. Remember the whole...
Oh, that's right. Yeah, there is another one. There is another one. Well, at least... I'll tell you what is definitely not one and only are apparently the shirts we decided to wear today.
I know, they're very similar, aren't they?
Yeah. Why did you choose to copy me?
It's like one of those times where, you know, like you go to a family reunion and all the wives got the husband the same exact shirt and none of the husbands knew, and they all show up wearing like identical shirts.
Yeah.
Yeah.
It is a little shocking for anyone that's not watching on YouTube. Our shirts are basically the same color.
Yeah, and we're in different states and didn't plan it at all.
We definitely did not plan that. No, we are finally in different states. You've been in Memphis for a little while and just got back. We had been in the same state, although
that's like NorCal and SoCal. You don't see each other.
That's exactly right.
Back in California.
It's a beautiful place. You're back in the desert, right? Just in time for the hottest part of summer, right?
It's only 80 degrees here, and Memphis was 98 and 70% humidity, so it feels amazing here. Memphis was freaking miserable.
Yeah, this is we're recording this. I'm not sure when this episode will release. We're recording this in mid to late August, and it is not the time of year to go visit Memphis. If you're thinking about your Memphis vacation, I would not recommend August.
Me and
pretty rough.
My girlfriend Kelsey walked around the botanical gardens, and it was horrible. It was so hot. I mean, it was beautiful. They're great gardens. I'm sure I would have liked it in the spring, but God, was it hot outside.
Yeah, not the time of year. Well, you had an idea, or I guess we kind of sort of circled around an idea for an episode on misconceptions, and I think the idea of liquidity came up. Kind of jump right into this week's episode or this week's topic. I don't know. I've got some thoughts on this. We talk about liquidity, and I think there's a bit of a misconception that liquidity, particularly stock market liquidity. So people who you want to, we'll Adam and I will hear often from investors about this is a downside of real estate and a downside of private placements is that it's not as liquid as a stock market, and that provides some sort of psychological safety blanket to people, I think, knowing that they could sell the stocks and be in cash pretty quickly. But I think there's also some downsides to this. I wrote an article in the newsletter back earlier this year. We'll link to it in the release notes here, but definitely had some thoughts on this. So I don't know, Adam. I'll tee that up and let you take over if you've got any initial thoughts here.
I think the part that's funny to me, I'm on an email thread randomly, and this is a bit of a side note, but about someone out there is going into Bitcoin. One of our friends got an email that said, "I'm 100% into Bitcoin." Then he forwarded it to like 6 different people. And when he did that, someone responded this morning, and it's just turned into this kind of funny email chain. But when he responded this morning, he said, "I'd prefer to get rich slowly." And I think that's when I look at all the people that are wealthy and are doing good on, like, they could buy whatever they want any month. I mean, maybe not a new jet, but they can take their jet places, right? They can go buy a new lake house whenever they want. They're not worried about liquidity of their investment. They're worried about cash yield, right? And return on equity. And I think so much of the population is concerned that their equity goes up, and that, okay, the thing's liquid, I could sell some if I need some money. They pay zero attention. I mean, you don't normally look at a stock and worry about what the dividend is on it, right? And I think that's a big miss. So many people are trading, I think, true wealth and true cash flow and ability to live a good life for a balance sheet number, essentially.
Yeah, I mean, I agree with that. I think that this, I wrote about this in the article that again we'll link to it here, but um, I think this idea of being able to sell instantly as being a good thing, I can understand the point of view, but I feel like it also misses a lot, right? And I think, Adam, to your point, the bigger focus, long term, kind of to jump to the conclusion here, the solution is, at least what you and I have come to, is focus on cash flow, right? Like if if your investments are paying you money every month, then the liquidity of those investments doesn't become that big of a concern, right? You really are, for the most part, only looking to I think there's this high correlation between people who are concerned about the liquidity of their investments and how much those investments cash flow, right? You tend, for the stuff that doesn't cash flow in a pure equity place, people tend to be more concerned about being able to sell it and go back to cash. Whereas for investors that are focused on buying cash flowing assets, they're not really that concerned about it. They're more concerned about how much cash is it sending every month.
And I just had a conversation with another GP the other day who has a large company. They do a lot of deals. They have very high IRRs. And they buy them, they fix them up, they sell them. Fix and flip multifamily, right? Value add multifamily. And we were chatting and I said, that's cool, but my personal investment philosophy is more long-term buy and hold, keep it for cash flow, sell it eventually, 1031 into a bigger deal, increase cash flow, improve return on equity. And he said, yeah, that's what we do in our personal portfolio, but our investors aren't interested in that.
Mm.
And that's why I go back to all of these conversations I have with investors. And I think people maybe aren't interested in that because they want the liquidity. They want to know there's an eventual exit. And it's a mindset shift, or maybe it's just they're not educated, right? And I think maybe that's the phenomenon here we're trying to, or theory that we're trying to kind of break through, which is there's a lot of value to just holding an asset that you know all the problems with. You fix the problems with. You know the cash flows, right? I mean, we just closed on an apartment building that I'll use an example of, right? When we were doing the inspections, it came back that some of the sewer lines clogged. Like one of them was clogged when we were doing inspections. And the owner's like, oh yeah, that happens. It happens every 3 months and we pay $300 for the sewer line guy to come fix it. And we ended up doing a seller negotiated credit for $15,000 for a possible one-day sewer line repair. But my point there is that you don't have to do that repair, right? You understand the building. They've owned it for 5 years. They understood that it's just a maintenance item they do once a quarter, right? It wasn't affecting tenants. Yeah. They just go and clear this line once a quarter and everything seems fine. So I think, to that note, being able to have a portfolio that you know and that produces enough cash flow for you to have liquidity and be profitable and live your life is much more important than having some artificial amount of liquidity from just a portfolio, right? Yeah. A stock portfolio, right? That ebbs and flows every day.
Yeah, and I think that's a great point. And you talk about an investment that you whether you're active or passive, right? Like if you're on the passive side of something, an investment that just might be something that's consistent, right? And you can understand and expect any sort of fluctuations, or you expect consistency from it because you know that that's what it's going to be. But I think, Adam, to your last point, that was one of the things in the article that I wrote. I think people completely overlook your general trade-off for liquidity is going to be volatility, right? By extension of something being more liquid, it will generally be more volatile because the price can move a lot faster.
Yeah, because it can trade instantly.
Exactly. And so in some ways, that's one of the reasons we really like real estate. Like the illiquidity of real estate is a feature in that it reduces those like ridiculous price fluctuations based purely on animal spirits and not based on, the actual like fundamentals of the property. And I think it's one thing to be able to like stomach the volatility. I don't like it. And that was something I learned very early on. I don't like volatility, which is one of the things that's drawn me more to real estate.
Is that why you just keep all of your money purely in cash? Just gold coins under your bed?
But the other thing is like keeping in mind that when you experience that volatility, like those, you may not realize the loss because you're not actually selling, but that's still like breaking compounding, right? Like now you've had potentially a down year or a lower year. And we've talked about this, and I actually wrote about this very recently, was the power of like consistency. And yes, you can have some like in stocks, and that liquidity can produce some pretty outstanding results occasionally, right? Like the animal spirits will push to the upside. But then when it pushes to the downside, that it doesn't just like wipe away what you did. Like you have to earn more than what you lost percentage wise to get back to where you were. And so that constant up and down over years will have an overall negative impact. And so if you say, well, I'm okay with the volatility because I want the liquidity, okay, but do you really need the liquidity? Like that's another thing. Like how I mentioned earlier, I kind of framed it as like a psychological safety blanket. And I think that's another thing that you have to kind of judge is, okay, there's nothing wrong with having some cash, right? Like everybody that we know says you always want to have a little bit of cash, especially in the bad times, right? But you don't need to have your entire, for one, you don't need to have your entire portfolio in cash. I think that's generally pretty a bad idea. But then keeping all of it in something that's liquid simply so you can have access to it, I think you have to judge, do I really need all of this? Like, is there going to be some sort of life situation where I'm actually going to need to take my entire investable net worth and have it in cash?
And on the note of compounding, something that's interesting to me, right? Like, you have $50,000, right? That's the amount you have that you can invest. You make $300,000 a year. You've saved up for a little bit. You've got $50,000 you can invest. Let's just go with random numbers here. And let's just say you can put that into investment, making that's 10% a year, right? That's $5,000. It's about $400 a month. Not huge, right? It's not going to change your life. But as that compounds, right? And now that, let's say you do that 10 times, and now instead of $400 a month, you're making $4,000 a month. And then that compounds. Instead of $4,000, you're making $40,000 a month. Now your liquidity no longer comes from the sale of the asset, right? Like I know guys making $200,000 to $300,000 a month on cash flow. They don't need to sell something to become liquid. They just need to wait a month, right? It means they have big bills, but I mean, that's positive cash flow. So they keep plenty of reserves, all those things. I mean, the numbers get bigger, right? I mean, you look at those same guys making $300,000 a month, and I'm concerned about paying my $20,000 or $200,000 debt off in 2 years. They're concerned about paying off their $20 million debt, right? Like the numbers change, but you're just moving around more zeros. And so those things that we're concerned about having liquidity about in regular life, there's not a whole lot that happens in day-to-day life that $300,000 can't solve.
Yeah.
Even catastrophic medical things.
Yeah.
Right? Like things that would bankrupt a family are solvable with $300,000 a month of positive cash flow income.
Yeah.
And so you don't need that liquidity to be able to go, oh, I got to go sell this, oh my God, it's in a $50 million real estate portfolio. There's no way that I would do that because I need that cash, access to that cash, right? If your cash flow is high enough, it becomes your liquidity.
Yeah. Yeah. And aside, like I think the other side to that is like knowing what that amount is. Like, okay, if you do feel like you need to have some amount that is available liquid for emergencies, right? I mean, stuff happens, right? There's things like there's a very legitimate reason for why you would want some quick access to cash.
You find
I feel like for most people, it's not the entirety of your portfolio.
No.
Like you don't need that within 24 hours to where you can click a couple buttons and sell, and then it's going to be in your bank account. And so that's why I think the idea of, well, it's there if I need it. I've got access to it. That is true, but there's a lot more nuance to that. And you have to step back and ask yourself, do I actually need all of that? And then if you don't, then you really have to ask, okay, well, what tax am I paying? Not like true tax, but like the volatility tax. Like what tax am I paying in terms of returns or lack thereof, or like hurting compounding by trying to maintain liquidity that's not really necessary? And that's really the end here. Like that's kind of what I would question people to, or what I would suggest people to ask themselves is like, does that line up? Does like the amount that you actually need, like that you have liquid in terms of like true liquid investments, does that line up with like what you would actually need in a realistic scenario in your everyday life? And then if not, what price are you paying for that? And then what could you be doing elsewhere if there was a portion, let's say 75% of that liquidity, you don't actually need to have liquid. Where else could that be working, generating cash flow, but building, wealth via consistent returns and not having that constant up and down swing you've got volatility destroying the long-term compounding. And I think that's kind of where, again, Adam, for you and me, we kind of look more towards, we don't want liquidity, we want cash flow. And so what are the investments that are going to send us checks every month or every quarter, or whatever, because that acts in a lot of ways as a substitute for that liquidity. I don't know. That's like I said, we'll link. I've got more thoughts. I've written a couple things on this. We'll make sure that those articles get linked. But this is definitely a big misconception that I hear often. We talk to investors who've never invested in private placements before, or even real estate generally. That tends to be a common thing. It's like, well, at least my stocks are liquid. Okay, well that's true, but let's start peeling back the onion on that and actually dive a little bit deeper, because I don't think you need your entire portfolio to be liquid.
Yeah, especially retirement accounts.
Yeah, exactly. That's a great thing. Like if you can't touch that, if that money was like in cash in the retirement account anyway, you still can't like wire it or ACH it to your checking account without penalties and additional taxes and things like that. So if there was a portion, go ahead.
Which is why we have a lot of investors who invest through their IRAs, right? Self-directed IRAs.
Exactly. That is a great portion of your portfolio to be in something that's a little bit more liquid if you've got a long time, a longer time horizon until you can access that anyway. So there's no reason for that to be immediately liquid. Again, not financial advice. We're not financial advisors, but just kind of thinking logically about some of these things and not getting sucked into the traditional financial view of things and kind of the marketing around that. If you actually start, again, thinking logically, thinking critically about some of this, I think most people end up coming to slightly different conclusions than what the mainstream financial advice is.
Yep.
Well, good stuff. We can keep this episode on the shorter side unless you've got anything else to add.
Nothing else from my standpoint.
Awesome. Well, everyone, we, as always, appreciate you being here. If you found this beneficial, go in, let the computers know, whatever platform you're listening on, if it's YouTube or listening to us on Apple Podcasts, go in and give us a positive review or give us a thumbs up on YouTube, or I don't do Spotify, but whatever positive thing you can do on Spotify. Adam, you do Spotify, right?
I think there's a like, maybe follow, something like that.
There we go. Whatever way, there's something that's there that lets the algorithms know that you're enjoying this. We would very much appreciate that and get this content out to more people. But we will head on out of here, I guess, on that note, and we'll look forward to seeing you on the next one. Everybody, just remember, where freedom leads, real wealth follows. Thank you.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.